Hey, and welcome back. Today we are talking about real estate and investment basics terminology. So, if you don't already know me, my name is Maxim Cruz. I am a commercial real estate broker as well as an investor. Now, just for disclosure purposes, and because I am a licensed real estate broker, all of the information that I'm going to give you is for information purposes only. This is not investment advice. Again, I don't know what position you are in, and if you need investment advice, I suggest that you meet with the right professional. So let's go ahead, and today we're going to learn regarding investments when we look at real estate and some basic terminology. Now, this is part of a series actually where we look at buying multifamily properties, income producing properties, 2 to 4 units using FHA loans. But if you're actually buying any sort of investment properties, this is a good basic, very, very basic scenario of what you should look into when you're looking into buying these sort of assets. So let's get right into it. All right, the first thing that you should start off with, no matter what, is making sure you know what the purchase price is, right? Now, in real estate terms, or if you ever sat down with a financial planner or somebody that actually manages financial portfolios, this can also be looked at as a capital cost. Now, you'll see actually down below, I have this highlighted as an additional capital cost, and you'll see why. But when you look at the purchase price, some investment scenarios and some investors, they consider on how much money are they putting down cash. So if they were buying that property fully in cash, that's when later on we'll talk about cap rate and you'll understand that. But pretty much the purchase price or the capital cost of what it's actually costing you. Now, just so we're clear here. Let's say you're buying a $300,000 property or $500,000. Let's say it's a $300,000 property and it is multifamily, 2 units. If you're doing 3.5% down using an FHA loan, your actual down payment is $10,500. So you can argue that the money that you actually put down to get that property, the money that you actually invested was $10,500, and then you could do your cap rate based on that, versus if you were buying it cash, the $300,000, and then you calculated what your cap rate is, you're gonna get completely different cap rate, and it's gonna just vary. So it's very important when you're speaking with the real estate professionals and when you're speaking with partners, most of the time, 99% of the time, when you look at the purchase price, the actual cost of the property, that is based on how you calculate cap rate, because otherwise your numbers are just going to be way out of whack. Okay? With that, you want to make sure that you get rental history, okay? And there's a difference between rental history and what rental market rates are. What's the difference? Well, if there's lease agreements between the tenant and the seller or the previous owner of the property that they're paying $800 in rent and the market rent is $1,600, well, guess what? You might be losing money or you might be making money when you buy that property. Because depending on how it's priced, if they're pricing that unit based on a cap rate assumption and they're only looking at the existing market, at the existing rental rates, but they're not considering the value add opportunities as well as the true market rents, this is where you have opportunity. Now, sometimes you don't see this a lot in the smaller 2 to 4 units. Sometimes I have seen this more working with clients in the 20 to 50 unit range, especially when there's a group of investors. They're out of town investors. They don't really know the market. They're buying the property based on the information that's being given to them, but then they don't actually know that there's more opportunity or something can get done. So that's where you have opportunities to make money when you buy the properties, because you know what's going on. And that's where everyone always suggests start off investing or start off with real estate in your backyard, okay? You can definitely buy properties now anywhere you want in the world, but when you start off in your backyard, you know the market, you live there, you shop there, your kids go to school there, you do activities there, whatever it is that you do, you walk your dogs there, so you know what areas are more desirable, less desirable, and what some real market numbers are. Okay, down payment 3.5%. This is where I said that sometimes you can look at this as a capital cost as well, because this is actually the money that you're putting down. So a lot of the times, for example, in a more advanced course, I teach this where we talk about the internal rate of return. That is actually based on that down payment number, because that is actually the number that you're putting down. So a lot of the times the people will say, well, I'm getting this amount on my money, and they're confusing cap rate with an actual return of what you're getting, but that's a whole different class. This is just the basic. Next are the closing costs. You definitely want to know what the closing costs are, legal fees, transfer fees, tax stamp, document fees, if obviously you're getting a mortgage because you're doing 3.5% down, if there's any points at closing that your bank are charging you. So knowing the closing costs is important. Reserves. A lot of the times now, especially today, in a 3 or a 4 unit building, the bank will actually request that you as a buyer, you as an investor, that you have some reserves, okay? And why are reserves important? Well, the bank wants to make sure that they have, you have a certain number of money in your bank account. So let's say your mortgage payment is $2,000 and they want 3 months of reserves. They want you personally to have $6,000 in cash. So in case there's any issues with the tenants or the property, when you acquire it, when you buy it, you have those reserves so you can pay that mortgage. So sometimes the bank will do that. Another part of the reserves here, which is very important that people don't consider, is actually an item, a line item that you want to add in as kind of a savings account where you're planning things ahead of time. So if you have an AC unit, or if you have a furnace, or if you're providing refrigerators, or let's say your roof is on the older edge and you're gonna need a roof, you're putting a little bit away in reserves. So when you do have to make those improvements or repairs, you have some money in reserve, so you're not strapped for cash all of a sudden. So that's another thing to look into. And finally, there's interest rates, that you should definitely know what interest rates you're buying at, because that is going to affect your final payment when you look at your principal and interest. Obviously, the lower your interest rate is, the lower your payment is going to be. So next we get into the expenses, okay? This is where you have your taxes, property taxes, pretty self-explanatory. You have your insurance, your property insurance. Now again, because you are buying an income-producing property, you definitely want to have liability insurance if anything happens, as well as property insurance to protect your asset in case of a fire, in case of flood, if you're in a flood area, etc., etc. On top of that, I would definitely suggest, this is from experience, that you require your tenants to have tenant insurance as well, renter's insurance. It's very, very cheap. Most states it's like $100. It's under $200 in most states for up to, I don't know, I think it's like $20,000. So in case anything happens, you're covered for some additional liability. And as well, if they have any damage, or if there's theft, or there's vandalism in the property, their personal property can be protected as well. So it actually benefits your tenants. So then you get, before that, you actually want to add in your expenses. So what's your water gonna be? Is there electric light utilities? Is there gas? Is there other maintenance? Is there a management, right? Even though you're buying this 2-unit or this 3-unit or this 4-unit property, maybe you consider hiring a property manager. Now, typically on a 2-unit or a 3-unit or even a 4-unit, it's very, very hard for you to be cash flow positive when you have a management fee, but it's something that you can consider in the future. So if 2 years or 3 years, you're gonna move out of that property, or you decide to keep on buying other properties and reinvesting your cash, you're gonna need a property manager, so you wanna have this management number in place. So that finally is going to give you a monthly payment. So your monthly payment is going to be your principal and interest, your taxes, insurance, maintenance, all that stuff. And with this information, having the rental history, so having real rental numbers, having the rental market rates, and finally what your monthly payment is going to be, now you can figure out what's called NOI, net operating income. Net operating income is very simple. It's pretty much your income, which is your rental history or whatever your market rents are that you're getting, minus your monthly payment of all of your expenses. So that would include your principal, your interest, your taxes, your insurance, as well as the expenses that are in there. So that's how you figure out your NOI, net operating income. All right. Next comes the cap rate. Now, cap rate is just short for capitalization rate. How do you figure out your capitalization rate, and what does that mean? A lot of people don't actually understand what that means. Look at the word capitalization, okay? The first word is capital. It's how quick you're going to recover your capital, okay? So, for example, the capital cost, and this is where I said that depending on how you look at things, in the future when you start to invest in bigger deals, you'll look at, yes, the property cap rate based on the purchase price, but then when you're looking at the internal rate of return, sometimes people get confused and they calculate it a little bit differently, but you'll see that a lot. So it's just good to see and ask, hey, how are you figuring out your cap rate? Are you looking at the capital cost, or are you looking at your down payment, or what its initial deposit is for you to get that unit? So capitalization rate is pretty much your capital cost, which is your asset price, is your net operating income divided by your cap rate. That's it. All it is a number. Okay, it might be 6%, it might be 13%, it might be 18%. Pretty much all you really need to do here is say it's basic algebra. So your cap rate equals NOI divided by your purchase price. And how did I get that? If you remember algebra, remember we just take the cap rate, multiply times the capital cost divided there, and that's what we have, why we have NOI divided by the purchase price. So this is really, really simple and really, really basic. I'm just looking over my notes here to make sure I didn't miss anything. Now, for some of you that are a little bit more advanced and you understand all this stuff, and you might be looking at syndication deals, okay? Syndication deals is a little bit different, where pretty much you are acting as a syndicator, where you're gathering a group of people, a group of investors to buy property, okay, in order to produce cash flow. Now, as a syndicator, again, it's very important that you understand all of this stuff, because if you don't get the right rental history, if you don't get the right expenses, you're gonna miss some things, and then you're actually gonna possibly lose money on your deals, or you're not gonna be able to know how to offer things. Typically with FHA mortgages, the property values are based on market value. So what does that mean? That means if in the neighborhood, in the vicinity, all of the two-family homes are selling for roughly $300,000, it's probably likely that that property is worth $300,000. It doesn't matter that it has marble countertops and all this stuff. Yes, you might get a little bit more on your appraisal, but it's not going to be worth $1 million just because you have golden toilets and golden roof and gold-plated windows and all that stuff. So it's based on market value. Typically on higher or commercial properties, things that are 5 units or above, or anything commercial, storefronts, etc., the price is based on the cap rate. So again, because the cap rate is a relationship of your net operating income and your purchase price, obviously if you're getting more cash flow for the property, and the average cap rate that's being sold in the area is, let's say, 7%, that's how you can get your purchase price. That's why, historically speaking, in commercial units, you'll see that things will vary all over the place as far as the pricing goes, but it's a relationship between your net operating income as well as your purchase price. Another thing for my syndicators, or for people that are looking to get more serious or into the next level of investing, one factor that I didn't add on here is actually vacancy rates. You want to make sure that when you're buying multifamily properties, you have a vacancy rate. It's not really a number, again, in a 2 to 4 unit scenario that you're looking into to adjust your purchase price for when you offer to buy that property. But again, in multifamilies, typically you do have a vacancy rate. You know, you might have some tenants that rent there for 10 years, but you might have units that are just churning over every single year. Maybe it's a smaller studio, whatever the scenario is, you know, there's some turnover, so you want to make sure you factor in for vacancy rate, and that's going to decrease your NOI because it's actually going to lower your income coming in, and then your expenses relatively are staying the same, so it's actually bringing that number a little bit down. Now, if I confuse you here at all, I know this is confusing, but just trust me, go back, rewind this, look at the terms one by one. And now comes the exciting part, okay? I know this was really basic, but now is when we're actually gonna start looking into different properties. So now that you understand how to figure out NOI, how to figure out cap rate, what we're looking into, rental history, closing costs, some reserves, some taxes, now it'll be easier for you to follow me along as I look through some of these examples. So make sure you save this video or you put a little note on it or whatever. Also, there is a sheet included which has some of this terminology on there and some other terminology that you could study on your own. You don't have to enter your email address. We never ask for you to subscribe or enter your email address in order to get the information. But if you have questions, if you need help anywhere that you're located in the United States, if you want to start investing with this, again, as a real estate broker with over 13 years of experience, I have built a database of nationwide brokers that specialize in multifamily units, and I can probably connect you with someone in your local area, and I'd be more than happy to do so. So with that being said, now comes the exciting part, which is analyzing the properties. Now, what's this gonna do for you? What this is gonna do for you is once you start to see the analysis and you're seeing the numbers over and over and over, and you're seeing the different properties and the different scenarios, when you're in the process of buying your own multifamily property or investing into multifamily units, it's going to be very easy for you to track certain things because you're already going to have seen so many examples, and you're going to know, okay, I know exactly what this broker is telling me, or I know exactly what the seller is telling me when they're comparing vacancy rates or when they're looking at NOI or cap rate, XYZ, etc. So I know this information is going to help you. Again, if you need to rewind this video, take some notes, slow it down a little bit, it's okay. If you need to rewatch this multiple times, it's okay as well. It took me several times to understand this as well, so I don't expect you to get it on the first run. So now let's get into the exciting stuff. Let's go ahead and analyze a few properties. Again, if you have a property in your area that you would like for me to analyze, I'd be more than happy to do it. I currently have a backlog of about 10 properties that individuals have sent me, so it might take some time in order to see the property that you sent me up there, but I'll definitely try to analyze your property and try to get the numbers on the board and get you the information that you need so you can make whatever decision you decide to make when you're looking at investing in multifamily. Again, we're here to help you. Maxim Cruz here, commercial real estate broker. Hopefully this information has helped you, and I'll see you on the next video.